Your variable rate loans particularly, although eventually possibly your fixed rate, are the controlled demolition explosives inside your personal finances, and you should remove them immediately.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for August 7th through August 14th, 2023, while supplies last. This week we feature Silver Buffalo Rounds from Bulmint in Bulgaria at just $2.50 over spot. The Bulmint Buffalo is a new take on the Silver Buffalo, with unmatched 4/9 fine purity. Bulmint pride themselves on artistry and design, and produce a fine silver round with dueling buffalo on one side and a portrait of a Native American chief on the other. These 4/9 fine rounds come 20 to a tube and 400 to a Bulmint exclusive master box. They are available at just $2.50 over spot and are IRA eligible. If you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Francis Hunt, the market sniper. Francis, thank you so much for joining us today.
Absolute pleasure. Thank you for inviting me, Elijah.
Well, it's great to have you. I would like to start by discussing kind of the ballooning of debt we've been seeing. I know here in the U.S., we saw the kind of suspension of the debt limit just a few months ago, and spending has gone completely parabolic. Your perspective on the debt situation in the U.S., deficits, and also around the world.
Yes, the interesting thing with the usual debt ceiling dramatics that you were subjected to recently in America, Elijah, is that they held off agreement for a fair bit, and essentially they'd looked behind all the couch cushions and found every last dollar that had fallen down the back of the couch here, there, and everywhere. And post actual agreement, there was very little cash battle in terms of cash balances anyway. So there was an immediate massive issuance of debt that had to take place on a whole bunch of things that were being held back until the debt ceiling discussions, etc., are over. So it's almost like you're a Netflix addict and an ice cream addict, and I don't allow you to put any of that on your credit card for an entire month, and then eventually I say, okay, now you can have a treat, and you literally binge on all those things and others. So this is kind of what had to happen, and there were lots of necessities that needed paying. Anyway, to update on that is in Q3, the Treasury actually asked for a full trillion just to get you through to the end of October. My apologies, end of September, which is for the end of Q3, and projects, although I would say optimistically, that they would need a further 850 billion to cover you from October to the end of the year. And this is not total costs. This is above the income that is diving, revenue income, IRS collections, versus interest rate payments and committed to expenses. So this is the shortfall. It's not the full expenditure. This is the deficit, the difference between your income. So it always helps to bring it to an everyday human being. But essentially, Elijah, I've cut your salary in half and I've doubled your expenses. The deficit is that ballooning in your shortfall for existence that you now need to put on your personal credit card, in essence. So this inherently is pointing to knocking on the door of 2 trillion to get through one half of a year, the second half of the year. And as I say, I think projections for income will have been, the minute they push it a bit further out, they get more optimistic. They don't like to let the fullness of the bad news come out in one hit. So they drip feed the poison. So I'm expecting that Q4 number actually to go higher. But let's just go with their number. You need 1.85 trillion. And what happens with that is new created money, which is borrowed into existence that the government needs, that somebody else takes as an asset in lieu of receiving future interest payments. Now, the question is, who's the somebody else? Because it's not you, and it's certainly not me, and it's not other nation states that are showing an absolute appetite for buying investment debt to receive, despite the increase in interest rates, that interest rate. So in short, we have an utter proliferation of debt, and I kind of use, I'm in Panama right now, and I can see the beach and I can see the boats. Debt is like sand on the beach, It just, when there's an absolute proliferation of something, it's not valuable. You're not going to be thanking me to come and bring a bucket of sand and put it on your doorstep every morning, Elijah. You say, rather take it away. I don't want it. I'm not paying for that. It's not worth anything to me. And in essence, this is my take on debt that most people don't realize. The debt-based system is in a state of failure, and it's in a parabolic degree. So you went from 89 in 1 month to almost 300 billion, 280s in, again, higher needs of expenditure. So tax take is absolutely spilling. And in fact, we're going to have a gent called Tavi Costa on, but if I share screen and just show you some of those financials, again, this is in our Substack, and I'm crediting Tavi Costa for this particular chart. But if you can see this right now, this US state local income and income tax receipts, I've just put a pink box around it. That was your tech bust. So this is income tax receipts, the outlook for it. That was during the tech bull market. That was your tech bust, how deep you dipped for what was probably a depression event, year 2000. Almost without doubt, the GFC, the great financial crisis as it has been tagged, was a depression event. And again, a huge, huge dip. We are here. We are here in 2023, friends, and we haven't turned back up yet. Note that those were the lows, they turned back. This can continue to go down a little further in terms of it. So the not recession, mega recession is here. I don't know what name they're going to give it. That seems to be their privilege to write the headlines. But my argument is this is a very, very big debt escalation period. The retail consumer is more hurt than they're saying. The notion that labor markets meant that they didn't go into a recession is absolutely rewriting history and rewriting definitions, which is very, very communistic. When the news doesn't suit what you want, change the definition. So that's my opening salvo for you in terms of the setback for how prudently set up the finances of the biggest economy of the world are right now, and that's they're in a very shoddy state.
Now, if we look back at those 2 points there that on Tavi's chart, and we've had Tavi on, a good friend of the channel here, and he's just does great work at Christ Guys Capital. I did want to ask you about how this is all going to impact the stock market and the general economy, because those other 2 points there that we saw where it went significantly negative, the tax receipts, that also coincided with stock market crashes and a huge downturn in the economy.
Well, let me again second your opinion on the great charts, and I'll answer your question with another one of his charts. And just further on in our Substack, where I selected 2 of his pieces of work, they were so on form. I did scribble a wee bit on it to make something even more apparent that I will do again here with you. But you're asking about the stock market, so that's their best benchmark being the S&P 500, and that chart's right there, S&P 500. It's the white one that you're seeing there. The blue lines pointing downwards are mine, and we're highlighting again, I've been quite explicit about the downturn, so I wrote in these pink boxes as well, but this is all Tavi's work. The US average corporate bond yield minus the Fed's funds rate. So this particular indicator, what he's saying is that which businesses are paying on their debt versus the Fed's fund rate. So normally businesses pay a higher premium than the Fed's fund rate. Otherwise, you just buy a risk-free, note the inverted commas, treasury, rather than take the business failure risk. What's actually happening is they haven't been able to push up the corporate yields particularly nearly as much. They haven't advanced, but the Fed fund rate has advanced. So the risk premium of actually having maybe a business which is highly leveraged and could fail has shortened. When this happens, that's the red line now that we're looking at. When you get this very low, you're not fully pricing in the risk of business to this fullness you are usually at a crisis. So that low that he put the little yellow point in, that's where you were. And that's what subsequently happened in the stock market, the blue line indicating the crash. That was .com. Then again, subprime, there's the extreme low. It's even lower than the .com. That's roughly where you were. So if I draw a straight line up from that extreme low, that's where you were on the stock market. That's what subsequently occurred. And then again, for the events of March 2020, you were here. Again, CV19, I've called it, and that's what happened in the stock market. So now we come to where are we today? The big $1 million question, or maybe this $50 million question, and you're here, and this is where you are in the equity markets. And my question is, what comes next? And this is what I suspect happens, that yield has to go back out. But can I point out also that this is lower than any of the prior crises also? In other words, the risk premium for failure has never been so squeezed. And this is the not recession, in my opinion. So I'll answer your question with another one of his charts. So I would be very precarious about being too benign around the lack of reaction in the stock market. One of the things that has supported the stock market is that so much money is being created. There is two forces. So we've spoken about the hyper-stagflation, that's our phrase, and that you actually do in fact have two forces in play here. You have the devaluation of money at such an extreme rate, that is the inflationary element. But then you're actually having the very poor growth rates on the consumer. Remember, the billionaire classes are doing just fine. The military-industrial complex, all the major businesses that are highly statist, that are what I'd call quasi-private rather than full private, and they're doing just fine. But the actual consumer is crushed. So that's why you might see consumer stocks actually not doing nearly as well. You might get a little bit of down. I think Apple had a underwhelming expectation on its earnings. They rely a lot on the consumer. So they had a big spit down. They're a bit of a bellwether stock as well, not to forget. So that eventually it gets into the likes of NVIDIA and all of them, the chips, if people stop buying devices, just lags and buffers. So overall, I would be very cautious about whaling into the equity markets right now. While we're at it, and being metals fans, and one of my own charts, I'll bring you back to the same blog post of ours, which, as I say, is on our Substack if people want to follow that outside. We do cover it also in our YouTube. But Palladium has been an amazing indicator. This is one of my own. What I'm highlighting here is the down legs in Palladium and their correlation to recessions. So you've got the Volcker recessions, which are on and off for an extended period. You've got the big collapse in Palladium. So the blue line is the Palladium price chart. The gray zones are recessions. The 1990s recession, again, they always make these recessions out a lot smaller than they really, really were. And remember, they lag, and there's a tendency to mentally enrich and say, well, we're all over it and we're through it. But there was another down leg in Palladium. The .com, again, I would argue that that was a much bigger event than the breadth of that gray zone shows. But you could see how punishing the move was for Palladium from there, a real crash down. So we're seeing recessions. Palladium is a precious metal with an industrial use, and you can see it again here with the events of subprime, a very hard fall here. During that. Then there was one other key year that many people don't know that I referred to, and that was when China's credit card got maxed out. Everything in 2009 till 2015 was how China was going to rule the world. They were building more, they had more cranes, more skyscrapers. They were just shoving property up at a ridiculous rate, and then they ran into a credit crisis. And that's actually started a lot earlier than people realized. That was 2016. All the central bankers got together and they had a secret meeting. There were no minutes released, and that was what Jim Rickards and others have referred to as the Shanghai Accord. So there was a real problem there, and you could see we had a Palladium reaction there too. Then we had CV19 again. That was over very quickly. It was a sell-off, it was brutal, and then it was over. Again, that's a very small gray area that they're showing for what was actually shutting down the entire global economy. These two gray boxes were put on by me. It's the recession that wasn't called of 2016, and it's my opinion, the not recession with the subsequent correction in Palladium over there. So Palladium is actually a very good indicator. You may find the same to a certain degree with silver or others, but particularly Palladium. Silver has a monetized value, and gold has a monetized value. And we actually pointed out that gold, and particularly against palladium and platinum, is an outperformer. So we have technical chart structures. I can show that to you if you like, but I think that's the monetized aspect of gold, where palladium particularly, there's no palladium coins. There was never a currency, although it's very, very scarce and very precious, a bit like platinum. So that's another answer on where we are macroeconomically. I think people should understand that things are probably a lot worse than they think. You mentioned banks as well. There's a very quiet storm on the go with smaller banks getting mopped up as well, which is probably a function of combination of interest rates, distressed credit, and many other things. So you could suddenly have an outbreak. We haven't got a headline yet for the not recession. I gave it that name out of sarcasm, but I'm sure one will be provided by the mainstream media in due course.
Now, when it comes to the banks, I know we have seen two more banks, one being taken over by a larger bank, PacWest being taken over by Bank of California, and then there was a small Kansas bank that just recently failed in the last couple of weeks. So your perspective on that, because as we mentioned, this rise of interest rates, that's a big factor when it comes to these banks failing or needing to be taken over, is their balance sheets are being crushed as their bond holdings are losing value.
Absolutely. And again, I take it back to the grand macro. We have a proliferation of debt, and debt has to go down. Your biggest fear should be an interest rate spike. Everybody sits and wants to be pivot calling, although I've seen a little bit of a reduction in the pivot calling, but there were so many when pivot. And I'm like, you're talking about debt. Pivoting means reasserting strength for the bond market because it means rate going down. And in actual fact, our biggest problem is there's a proliferation of debt and it has to be devalued to zero. You're more likely to get disorderly interest rate spikes. And my big concern for everybody is that your variable rate loans particularly, although eventually possibly your fixed rate, are the controlled demolition explosives inside your personal finances. And you should remove them immediately. It really is like having detonation charges on every structural pillar of your personal finances. And debt should be eradicated, because many people go, oh, that's great, debt is going to get devalued to zero. No. Not your credit card and your home mortgage is. The asset class that is being held by your pension is going to encounter that. And the economy is going to encounter the effects of that. And you don't taper 40 years of bull market over 40 years. It gets disorderly. You're not going to land this lead balloon softly, in my opinion.
And how do you see that during this not recession, or whatever they end up calling it? How do you see that precious metals will react?
Well, there's two aspects to that. The medicine we'll see that they will see an excellent reaction out of precious metals. However, some of the prelude into that can actually be disinflationary on valuation. So if we were to have a demand-destroying event, the initial problem for everybody is they run for cash. They need money to pay rent. They need money to do everything. And everything that has some element of liquidity to it that can be bought or sold gets sold. So initially you could have a dip in that. We haven't looked at the charts yet. I want to highlight that it might be worth transitioning, taking your question and just building a little further on it by pointing to the gold-silver ratio. The gold-silver ratio is my favorite indicator for when we are ready. to move forward on the downside of the gold-silver ratio, which is bullish for the silver and gold. And what you can see right now, got a lot of draws on here and a lot of alerts. You can see I really treat it as a tripwire event, but this is where we are. And currently, actually, we've had a run up in the gold-silver ratio, which has been the fall of silver from the 25s into the upper 22s, which is, it's shed close on $2.5+ dollars, and also gold coming down to round about the 1930s. So it's slipped off quite a bit. What happens next? We had a very seminal moment, because you'll know from our multiple visits that we suspect, and I'll go up to a slightly bigger time frame on this indicator, the weekly time frame. Our primary scenario is that at some point soon, you will break this level over here to the downside with the gold-silver ratio. So in essence, you have this structure. There is a D-Day coming for this. And at the moment, you're moving up. It's a question of how far up. If we were to break this capping line and have a strong move over here, our bull market for metals is going to get pushed out if we were to do anything like that. However, if in the not too distant future we stopped climbing and we started waning a little bit and showing some decay on the gold-silver ratio and started to come back down hard like that, our primary setup would still hold quite a lot of store. So this is, as I say, quite a seminal moment. This basing ascending grind line, as we call it, is something we expect to fall to the downside to bring us to the 65s levels, which is part of that right shoulder, massive blow off head. We reiterate again, 2020 was the peak bonds and was also peak gold-silver ratio, the most undervalued silver and low valuation for gold that you get out of this ratio. We had 128 there, and we have a left shoulder just to my left there. So we are awaiting event here, and it's coming up to a key event, a key time frame. Are we going to stay within this, or are we going to break out? So there's a bit of a big narrative. And then on top of that, I'm going to add, Elijah, the last week of August into the first week of September is often a very directional week for precious metals. The back to desk September, the first Monday of September, we called the breakout of $1,000 in 2009 on gold. That was some time ago and I need the gold chart for that. So let me just say goodbye to gold silver. And we had knocked up against 1,000 many, many times. And people had become very much like they are now towards precious metals. You need a patience of a monk, and you sit around waiting for something to happen, and nothing happens for years. It was pretty much this period over here. And the 2nd of September was the day. I actually had a thread post that when did we break out? And there was a specific day when it started its move. Again, a squeeze like this. And you'd not have been able to hold above 1,000. You did put a technical 1,030 there. You were resisted there. You were resisted there. You were resisted there. And we have never seen 1,000 again, even in the bear markets, the pullback lows. And we ran all the way to the footstep of the next millennial in gold, 1900s and 16. So when you let go of a key 1,000 level, you let go of it big. And the argument I make to you is that it's a very similar juxtaposition that we have today in this. So I'm actually biasing that the gold-silver ratio will actually pivot at some point not too far off, but I can be wrong, because we have a very similar type situation with the 2,000 value. There is no holding on the big time frames. I'm on a monthly up top here for a sustained period yet. But the pullback here has been far more mixed than the crash. Don't forget, this was Powell and 4 0.75 interest rates hikes back to back, when he absolutely rushed the rates. And you'll be aware that the prospect of a very steep rising rate cycle is generally not initially very good, especially if it's coming in more aggressively than expected for the gold price. And that put a bid under the dollar quite extensively. So we're unlikely to get that kind of behavior again. If anything, we're going to see more and more evidence of the economy slowing. So this downside will not be as deep, and we may well be becoming ready for a September assertion. And once we break the 2000, much as we had for the 1000, my argument is going to be that you don't see 2000 again. It will serve as support. You might immediately technically just test it and run below it. But once you've had some degree of time, that forms as a cyclical support low, and we could run to the next 1000, which is 2,900. Our technical targets have taken us to the doorstep of 3K. So that's our take.
And in this environment, where do you see silver running then, if you could share the charts with us?
Yes, absolutely. So initially silver, kind of weak, but prone to being far more schizophrenic. It can go from being really weak to, if gold starts to put in good days and good bases and starts truly building, to being rather strong. And I'll highlight probably the most important silver chart time frame is actually a very big time frame one, Elijah, and that's I'm going to literally, every candle here is a 6-month candle. So 2 candles represents a single year. And I'll highlight, taking us all the way back to the Volcker years, that the 45 to 50 price range, so that goes back to, Hunt Brothers, etc., Volcker, etc. This was the resistance that you got, 45, 50 gateway. In 2011, we made that level again. And we are out of this continuation structure. When it turns, we are projecting that you will get brought to this range again when this breaks to the upside. So if gold starts putting in some good days, gets above 2,000, holds 2,000 and starts building on it, silver's response will be to go to the $45, $50 range once gold has shown that it is clearly sustainable in that range.
As for what our viewers should be considering right now and looking towards as we approach this recession, possibly, your perspective on the key things people should be paying attention to.
Eliminate all personal debt, especially that which has a variable rate. At the same time, accumulate so that you also have some saving. It doesn't always feel good to only pay off debt. Certainly accumulate long-term your local currencies coins. So I think for Americans, get your Eagles, and I would say the Britannias for the British, etc., and maybe Kangaroos for your Australian audience, etc. So locally, start getting your drip feeding your bullion in, but eliminate debt. I'm actually positioned short on debt by choice. So there is an ETF, which called TLT, that you can short, that is long-term debt. So there's just too much of it. It has to be deflated away. More and more people are realizing, I feel, like the conclusion we came to in 2020, August, where we said that was peak debt. This is the end of a 40-year bull. More people are starting to make that seminal. I get much less resistance now to the fact that I'm actually calling a top on a major market after 40 years of inflation. Everybody goes, ooh, I'd never do that, bonds will be back. Nowadays, there's far more acceptance of that fact, but the book isn't showing that. It truly needs to go down. So shorting on debt, if you are a trader or investing person, you can maybe get an anti-debt, a short on an ETF. But for people that are non-traders, the downswing of that deflation of debt is going to be very, very polarizing for wealth. Avoid the digitization too much of assets. While there's some value to having a bit of Bitcoin and crypto, yes, I'd expect BlackRock. So BlackRock's record on getting ETFs is they've had one declined out of over 500 applications. They now have an application in for a Bitcoin ETF. It's the first time they have. I would expect particularly Bitcoin to do rather well during that period, so Bitcoin dominance period. So there's no harm in having a bit of Bitcoin, but don't think this is your freedom money. I'm cautious about what comes with digitization of all our assets. I think your property is eventually going to be put into NFT tokenization on the blockchain, and you will easily be purchased out of it. And so I would be old school and resistant to the excessive digitization of your personal assets. And having what I would call dark assets, for example, your bicycle, nobody knows how many bicycles you have, Elijah, maybe is a good thing. So those are a couple of general preparation points I would make in terms of the longer macro in where the world has been taken.
Fantastic. Well, Francis, we always appreciate your time. Where can our viewers find you online if they're interested in learning more?
Oh, absolutely. Our YouTube channels are fulcrum of everything. If you're interested in the crypto, there is The Crypto Sniper. But our primary channel on traditional markets, of which precious metals is a lot, oil, commodities. And by the way, we expect after whatever crash comes, a very strong commodity market in our hyper-stagflation model, which goes beyond gold and silver as well. We cover a lot of that. We do equities and indices, all the traditional markets under the Market Sniper. Those are also our Twitter handles. If you want to book a call and have a chat, our goal is to help people build wealth. And there will be amazing opportunities. Unfortunately, in the breaking down of an entire system, there are actually incredible opportunities that are created. Suddenly, new things have to emerge very, very quickly, and other things disappear and collapse very quickly. So, fortunes can be made. But unfortunately, for the average man in the street, it's going to be a very polarizing and wealth-destroying event. You need to take active control over your wealth building, and we aim to do that in reset times. And those are different times to the last 40 years of expansionism that we've had.
Fantastic. Francis, once again, thank you so much for your time, and God bless.
Same to you, Elijah. Thank you for having me on.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.